Crude oil now higher after struggling a little bit this morning as equity markets staged a turnaround. WTI has joined. Let's bring in Scott Bauer, CEO of Prosper Trading Academy, and move through some of the non-stock stories of the day. So Scott, crude oil had a really nice move here the last basically about a week or so as it got up from around $35, $36, made all the way back to 42 nearly. Today, not quite as buoyant as equities. What do you think about WTI right now? Are we going to be stuck in this range?
So we had this conversation week and a half ago when I was selling put spreads. If you remember, we talked about that when crude was trading around 36 or so. Now I'm selling call spreads because I do think that we are going to be stuck in this range. I think we got a little overextended on the downside, quite frankly, Oliver. It went a little bit further than I thought. But, man, I just don't see how we get more upside here at all without some reopening. Again, I mean, it's the same story we've talked about. And I don't care what the metrics are that we get from the EIA or, inventory builds or drawdowns. I just don't see how we break out of this range. Maybe 41 pops on the upside.
So crude then at just below 40. Where do you pick your strikes for where you want to do this, Scott? Walk me through what kind of a spread you see as being a good one to sell right now to the upside.
Yeah, I'd be selling a near term like a 41, 43 or a 42, 44 call spread. Keep it pretty close to the vest, but trade this range just as I was selling on the downside, like a $2 wide put spread, 36, 34, 37, 35. Same thing here, and just play that range until it breaks out. I just don't see it breaking out anytime soon.
What about on the other side of the commodity space for energy? Natty gas, you been keeping an eye on this at all, Scott? It's just gotten totally blasted. I don't know if there's any range there.
I mean, it's back to being the widowmaker. For a while it had such a nice run in the three handles, actually. But no, it's
short-lived.
Very short-lived. I haven't done anything in there, but it's there. It's there.
All right, $1.80 right now, undoes like a month and a half of gains. So you're steering clear of nat gas, dabbling with oil, basically kind of fading any further strength from here. Now, what I'm kind of hung up on, Scott, is the dollar today, because the dollar has been this very sound signal that when it's higher to watch out for risk assets. And, I guess maybe gold down, crude struggling, some of the commodities struggling. Maybe there is dollar action there, having an influence, but it doesn't seem to be getting in the way of the stock market at all, which is kind of new.
Absolutely, it's new, but the correlation between the dollar and gold has been pretty locked up for quite a while, and it still is. And to me, it's really, I don't understand, quite frankly, how the dollar is getting some strength, especially on the heels of Powell's comments and the rest of the Fed governor's comments. Yet we're seeing it pop up. Now, 94 is a pretty critical level in the dollar. If it really breaks through here to the upside, Oliver, which I don't see happening, we could get up to 96, which would put a world of hurt in the gold space in the near term. I don't see it happening. So I'm looking for some major resistance in the dollar here, which is why I have another bullish trade in the gold space.
All right, you're going bullish on gold.
Back to the well.
All right, you're going back to the well, right. And to your point, a lot of these charts right now, they look really interesting. If, gold holds up at 1900, then we've seen that be a great support point before. If it breaks to the downside, I don't know. It looks like there's a good bit of room down there to 1800. Is that not?
No question.
Does that give you a weak stomach, Scott, or what?
It doesn't, because everything I'm going to do is always risk defined. So if I lose, I lose, but I know what my risk is going into the trade. So I'm not open-ended. What I'm doing this time, Oliver, not GLD, which is what we've talked about quite a while over the last few months or so. Okay. I'm actually going into the GDX now, which it's similar, but this is really more on the gold miners, where GLD is tied pretty closely, to bullion, gold bullion itself. This is really the gold miners ETF. There is some very, very critical support here around 39.50. So I'm putting on the old Texas hedge, where I'm selling a put spread and buying a call spread at the same time. So my put spread is financing most of the purchase of my call spread. Okay. So going out to next week, October 2nd expiration, selling the 39.37 put spread, pretty close to being at the money here, buying the 40, 42 call spread, also pretty much at the money. And I'll pay about 20 cents to do that. If gold breaks down, so if the dollar continues its rally and gold in general breaks down, I've got $2 risk to the downside, no question about it. But I am completely locked in and risk defined.
Okay, all right. So I like this. It's got a lot of different parts to it where at the end of the day, you're kind of just taking what would look like a traditional profit and loss for a spread and just kind of skewing it out. So you can go a little bit more, get a little bit more, but also you can lose a little bit more too to the downside, but you still know where you get cut off.
And I wouldn't do this if I was not overly bullish. I only put on this type of trade, which old traders like me used to call Texas hedge down in the pits. Only put on this type of trade when I'm really, uber bullish, or I could do it for an uber bearish side as well. This one happens to be to the upside.
All right, gunslinging on gold. Scott Bauer's back, baby. Appreciate it, Scott. Thanks for the 2 trades here. He's the CEO
Thanks, Oliver.
at Prosper Trading Academy.